Ooh, seeing a lot of yeses come in. Love that. 8 out of 8. Now, I also want to just invite everybody who's already here. I'll say this a little bit later also, but if you have questions as we go through this webcast, as questions do come up, please feel free to put those into the Zoom room chat. We have a moderator here. He's going to be filtering through those questions, getting you quick answers back, or if it's one that's would be better answered by panelists, we'll have the panelists talk about that in the Q&A section at the end. So as you're going through, rather than holding your ideas to yourself, if you have a great idea or a question that you want to have voiced, please feel free to bring that up, and we will try to address that in the Q&A afterward. Just about 60 seconds away now. A lot of poll results coming in. I love that. 11 of 12 have said yes so far. 1 no for exposure to digital assets. Very cool. All right, it is noon Eastern time and time to get into this. So I want to take a moment to say welcome everybody to this What You Need to Know About Digital Assets RIA focused webcast. Very, very excited to have you here. We have some amazing speakers today. We've got James Wallace, the co-chair and CEO of Exponential. We have Kyle Fry, president of Exponential. We have Stephen McClurg, our chief investment officer, and of course myself, Sunny Durante, the director of marketing. So I want to take a moment to say hello to our speakers. Guys, thank you so much for being here.
Happy to be.
Awesome. And so why is somebody on this webcast? So you're here, if you're listening in, you're here because maybe you're curious about digital assets. Maybe you've got clients who are asking about it, or maybe you're interested as an investment option for yourself, but you're just not fully versed inside of digital assets. And I want to just share that our commitment to you is that by the end of this webcast, you're going to have a really clear, solid understanding of digital assets, such that you can go out and confidently speak about them to your clients, to your colleagues, to your friends, and feel really good in your knowledge about that. And if you have questions moving through this webcast, I'm going to do our best to get right into the content here. So I'm going to run through some of the house cleaning very quickly. If you have questions, please feel free to put them in the Zoom room. We have a moderator inside of the Zoom room who's going to be looking at those questions and trying to answer them. And if they're worthy of being answered on air by one of our panelists, we'll have that happen also at the Q&A section at the end. So please put that in there. Also, if you want to connect more at any point during this webcast, you're interested in, you have maybe some specific questions that are not being addressed here, or you want to talk to somebody one-on-one or find out some more information about anything we're talking about, you can head over to the URL on the screen there, go.exponential.io/RIA info. Go.exponential.io/RIA info. That URL will also be on the bottom of all these slides that you're going to see, but you can head over there and that'll give you the option to book a meeting with one of our teammates, get more information, or even directly access some of the opportunities we're talking about here. So a quick touch on the disclaimer. Nothing inside of here should be construed as legal, tax, financial, investing, any other information. This is purely for informational purposes only. You can take a look at the disclaimer fully on the screen there, or if you want to take a look at it at a later time and read through it fully, we're not going to read it here. You can head over to go.exponential.io/webcast disclaimer to read that all the way through. Okay, let's get into it. So I want to say again, thank you for my guests being here. And I want to open up with, we hear about digital assets and, it's almost a buzzword that's beginning to be thrown around now, but I think that people sometimes are lacking the understanding of just how pivotal and profound this technology is, because they don't really have a connection yet to what it is today and what it could be. So I was hoping, James Wallace, would you take us through a little bit of what's the vision that you see today for digital assets and also in the future?
Sure. It solves massive market problems as it relates to capital markets, at least. Blockchain offers a lot of promises, including voting systems, anything that you need, essentially a trusting environment that manages a broad group of people. It does it automatically and immutably. It solves for very well. It just so happens that it solves very well for capital markets. So some of the promises, and I think a lot of the people that are on this webcast understand the cost of capital markets is fairly significant. A lot of the times, with robo-advisors and cost of trade going to what appears near zero, it's hard to see that and appreciate that, but it's built into the product. Like we know that the buyer of a house doesn't technically pay the the agent's fee, but they do because the seller bakes it into the price. So the cost of the capital markets and cost of the trading is going to go to 1/5 to 1/10, utilizing distributed ledger technology. Counterparty risk goes to near zero. The T instant, T right now, the transaction time occurs right now, not 3 days. So there's no counterparty risk. The buyer sends their fiat and receives their security or their asset instantaneously. So there's no risk. The cost of capital too, posting capital, about 5% in a T3, so a transaction 3 days scenario, about 5% of the trade needs to be posted in capital. The fact that it's T instant and there's no counterparty risk, all that capital goes away. Another thing that's really exciting is it's global. So the capital markets and securities laws and fund laws, asset management laws are very tailored to the jurisdiction. This sort of technology is going to enable that across multiple jurisdictions programmatically and automatically, which is exciting. And then the community aspect, essentially the financial inclusion part of it, and the liquidity that goes along with that. So bringing the public into almost anything simply by the nature of the technology itself. So as you can hear and see from a technical perspective, and again, really understanding RIAs and others that are fairly sophisticated are on the call right now, talking more about some of the capital markets benefit. But on the public side or the investor side, really, getting access to investments that they otherwise wouldn't be able to access simply because they're much more secure, much more efficient, et cetera.
So so thank you. That's fantastic. I'm curious about, well, another thing that comes up is people are now beginning to understand the vision. You've spoken to that. I think that there's kind of a gap in the technology of it. So, you hear these words, you hear distributed ledger technology, people hear blockchain, people hear Bitcoin. And I think that, in the people that we've spoken to, there's sometimes a disconnect between what are all these things? How do they all fit together? Because they are in many ways related. Could you walk us through a little bit of just a very quick primer about perhaps distributed ledger technology, and how that ends up in digital assets, just so that we have kind of a theoretical framework that we can understand this in a simple way?
If you're a bit confused right now, it's okay, and it's completely understandable. So give yourself permission to still be struggling in part to understand it. There's a few reasons why I think a lot of people struggle to understand it. First of all, this is a solution. So as I mentioned, a currency solution, a capital market solution, a voting solution that was created by a bunch of technologists that aren't really incentivized or maybe programmed or maybe even capable of articulating this in a way that the masses understand. So typically there's additional layers when a new technology is created. There's additional layers that help it go vertical into a market and allow, the consumer, and in some cases like in our RIA, people that represent the consumer, to understand it. And unfortunately, this whole space is still fairly dominated by technologists who, as I said, are just not really equipped or capable to explain it. The other reason I think is corruption, and whether it's intentional corruption or unintentional corruption is probably for another webcast or maybe just some barroom talk. But the capital markets, environment itself, and again, I think everyone on the webcast has seen this firsthand. Definitely read about it and seen it. We're living in the era of billion-dollar fines against banks and trading companies for infractions against securities laws and so on. So I think that there has been a concerted, very focused effort to attack it. And putting the conspiracy theories aside, I think it's just important to recognize that people that dominate a current system are incentivized to not see disruption within their system. So I think that there's been a lot of that as well. Now, to really understand this, I think, metaphors and analogies typically allow us to get to comprehension quicker. So if we put all the technology aside and just trust that it works, because we literally have tens of thousands, maybe hundreds of thousands of programmers now worldwide that just state it works. And so I think we're past questioning the technology itself. You can really think about blockchain as essentially an app store, or an operating system that has an app store that's built on top of it. And we all have either probably at this point an Android or an Apple phone, so we're very familiar with the App Store. The blockchain is sort of that infrastructure that does clearing and settling. The App Store is something that allows us to customize our experience within that environment. So let's just call it a global financial ecosystem. And one of the first apps that was built into that global financial ecosystem was Bitcoin. And in 2009, it came onto the scene pretty hot. It's been the media darling and financial analyst darling off and on ever since. People have been struggling to really understand it. But the reality is that it is essentially, I mean, it does run its own blockchain, but staying with the analogy and just assuming that we're running all one single blockchain, it's just proven the value of a distributed ledger, which again, the fact that it's trustless, which is a weird statement. It basically means you can trust it absolutely. That is a great way to manage currency. So Bitcoin came onto the scene. We've had some competitor currencies that have emerged as well, which is pretty exciting. But when we think about Ethereum, I think the next thing that anyone heard after Bitcoin, it probably went Bitcoin, blockchain, then Ethereum, was the innovation of a smart contract, and we can just think about that as app number 2 in the App Store. And this allowed for programmatic things to be coded into a contract that happened magically, which created a lot of efficiency for trades and enabled what now I guess we can call the third app in the App Store, which is digital securities and the securitization of everything, which enables, again, cross-border trade. It enables fractionalization, portability, et cetera. All of the wonderful things that we want to see in assets are enhanced substantially by blockchain, distributed ledger. And anyway, so Sonny, I hope that's a good enough sort of analogy to help understand that.
And absolutely. I just want to add something and reiterate what JW said. On the technology side, that's probably, if you've done a lot of reading and you've seen about the industry, there's probably still sort of a bad taste in a lot of people's mouths, because all the headlines over the years have been that technological approach where people said, oh, I can mint a token and start selling it outside of securities laws. What we're talking about now is highly regulated and within global regulatory frameworks. And the good news is while we're living within these frameworks and building the digital security within these frameworks, the regulatory progressiveness is converging to the same points. So changing the definitions of what a retail investor is, all of the major players in the world are getting involved on the regular digital asset side. The SEC has continued to push the envelope in terms of how to think about digital assets. So technology was the approach. Bad actors, I always like saying this, blockchain and DLT is not a panacea for crime or bad actors or terrible people. Fraud exists. It does exist in traditional markets. This does not solve that issue. It doesn't make people good. But the reality of it is there are a lot of systems in place, and we can actually take a lot of decisions away from human beings and put it into technology. And now we have the technology to actually do that. The capital markets, and we work very closely with the Global Stock Exchange, GSX team. The capital markets has been evolving over 200 years. And so the technology has not kept up with the needs and desires of people trading and investing and buying and selling. And so the reality of it is you have multi centuries of adding pieces into a puzzle that technology today could literally solve without including any of them. So the approach over the years has been technology. The headlines have been fraudulent, bad actors, and people taking advantage of the system. We are operating in a highly regulated space, the same regulation as current securities laws. So I just want to add that and reiterate that what JW said in terms of people approaching this from a technological perspective, you can't approach this from the technology perspective. You have to have a deep understanding of the technology, but you have to layer in regulation and knowledge of capital markets, which is why we have the team we have here together and the players, because you need all of these pieces to really understand it.
That's so valid. And I think it's really interesting to consider that the technology that's now baked into this actually allows for the securities regulation to perhaps be even more effective, right? Because like you mentioned, they've removed the opportunity for a lot of third-party decisions made by humans. And now we can go in and, there's at least a level of security baked into that. I think that's really, really interesting. Now I wanted to switch it over to Stephen for a moment. So you and I had been talking previously, and you had a really great example of to really hammer home the point of just how familiar a digital bond versus a traditional bond would be. And I was wondering if you could share that story that you shared with me previously.
Yeah, thanks, Sonny. Thanks for having me. So, really most of my background and experience is trading and managing bond portfolios. And one of the things that really excited me about blockchain, and particularly when smart contracts that James described became a thing, was a lot of innovation that it can have in fixed income. So, for instance, when you're trading bonds with a counterparty, you often have 3 to sometimes even 10 days settlement, and some people kind of scratch their heads and think, well, that's a really long time. Treasuries are sometimes T+1. But there's been situations where I've dealt with a counterparty, and they have a bond that I've bid on, and I've received that bond supposedly, and we've wired the money, and 20 days later, I'm getting calls from our custodian saying, "Where's the bond?" And come to find out that the counterparty that we were working with had shorted us the bond and had still not delivered it because they never actually owned it to begin with. They simply shorted it at a price and been out in the market looking for that bond. And if it's something that's esoteric, they may not be able to find it, and they may have to pay up for it. And if you don't trust that counterparty, and that's where counterparty risk comes in, then you may not ever get it. And if it's a situation, say in 2007 or 2008, when we started seeing some big banks fail, and that bond was shorted to you, and 20 days passed, and say that bank failed, it creates quite a bit of panic. One of the things that when you're trading bonds is when situation happens where there's a panic situation, like a Lehman Brothers or a Bear Stearns or a Wachovia fails, the market sees up, and all trading comes to a halt. And the reason why all trading comes to a halt is because you don't know who you can trust. You don't know which counterparties are good and who's going to be the next one to come down. And you don't want to wait that 1 to 3 to even 10-day lag of receiving something that you paid for, because you don't know if you're going to receive it or not. And this is really important, kind of hammering home the point that James made earlier on counterparty risk. So really, to explain what this innovation can do, even for the bond market, is if I owned and I'm trading bonds and say Apple, which is a company that everybody knows, and right now those bonds exist in paper format. You're buying and selling it from a counterpart. And like I said, even though Apple is a strong credit, strong company, you still have counterparty risk of the person that actually owns and selling the bonds to you, or that you're selling to. And in paper format, there's a bit of a delay. But when you digitize the format of the bond, what essentially it does, it takes away the paper format and allows you to trade it right away. So everything about the two bonds are the same, whether it's a digital or paper form. Same bond, same credit risk, same regulatory. You're still being regulated by whatever regulatory agency in the country that you're in, that you're trading the bond in. Nothing changes. Ownership doesn't change. Nothing changes. The only thing that changes, the only thing that's different, is the format that it's transferred in, which is digital as opposed to paper. And that digital format eliminates counterparty risk and creates same-day settle. And that's really all it is. You're getting the same thing. And by the way, it's also much more cost efficient, because you're not dealing with several different people along the way. You're doing an instant trade, instant settle. You prove that you have funds, and the other counterpart proves that it has the bonds, has a digital signature on it. And once those two things are proved, they're electronically transferred, and now that digital signature, your digital signature, is now on the bond. And you don't have to risk, some bank that's shorting you the bond that actually doesn't have it, and you're not risking that somebody actually doesn't have the funds to cover it. So those are the things that digitizing just something simple like a bond can really do to make the space much more efficient.
So it sounds like you're saying digital securities, digital assets, these are actually very familiar things. They've just been enhanced to get rid of some waste and what sounds like a pretty glaring inefficiency that was already in the process.
Yeah, that's exactly right.
That's awesome. Okay, so I want to take everybody or give everybody an opportunity, if you're listening and watching this, to ask any questions that you have. You know, Stephen gave a great example there, but if you have specific questions, please put them into the chat. You're welcome to put that in. Our moderator will try to get you a quick answer back. And if not, we'll bring that into our Q&A section at the end. Also, if you are curious about connecting with a member of our team, this has got you to a place where you want to connect with a team member to understand this at a little bit of a deeper level, please feel free to head to the URL go.exponential.io/RIA info. You'll automatically be sent here after this webcast, but if you want to jump in quick, you can go there now. So, you know, there's a quote that we really like here, Corey, if you could bring it up, that comes from Robert Greenfield, former chairman and CEO of NASDAQ, that 100% of stocks and bonds trading on Wall Street today could be tokenized. And in 5 years, 100% of the stocks and bonds on Wall Street will be tokenized. So it sounds like there's this inevitability to this, and people are really beginning to see that at a higher level. I'm curious, Kyle, when you look at this, you have, you know, a deep financial background also. How big is the opportunity that is digital assets and digital securities? And what are some of the most exciting things that digital assets will unlock in the next few years?
Yeah, that's one of our favorite quotes. It's a great one, and it's obviously coming from someone that's lived and breathed capital markets through and through, of one of the biggest financial institutions ever globally. The opportunity is significant, but the good news is, from an investing perspective, the way we look at it, and for the RIAs and folks on the phone, we're still in the early innings. I think if you thematically can agree that going from paper to digital is more efficient, which Robert says so, we say so, we spend 24/7 thinking about this. Again, the opportunity is significant, but we're still early, and early means more upside. So once you can get around some of the basics, that this is an inevitable transition of all assets of trading, and it's probably going to come in phases. The ones I would focus on are the public markets. I think if people are trading in the public markets, you may say it's pretty efficient. There are cheap costs. There are ways to trade. But the back end of that is the amount of people, and the cost of capital is still high. We can bring that down substantially. But if you think about it from a global perspective, public markets on a global basis is hundreds of billions of dollars of cost savings. And I think Accenture put out a report on public capital markets, putting the cost at somewhere around $1 trillion, which is significant. Multiple hundreds of billions of dollars. And if you think about, let's pick Goldman Sachs, for example, their annual revenue is $30 billion, 30. So several $100 billion of cost savings in the entire system, just on the public market side. Real estate being another major asset class. I think everyone talks about it in circles around it because it's an illiquid asset class. And there's tons of esoteric real estate. There isn't an opportunity to fractionalize it, trade it, list it, move it, make it more portable, remove a lot of the cost savings and the paperwork that it takes just to go from buying to selling. There's a couple of companies we're working on. There's one called Red Swan in the United States, where a gentleman's been working on commercial real estate deals for 20 to 30 years. And all of the deals he's ever worked on are institutional demand, institutional buyers. But with tokenization, you can actually create an entire slug of equity that didn't exist before. That's better for the owners of these buildings, as well as accredited investors and others being able to get access to investments like that. So it's opening up access. But real estate's the largest asset class in the entire world, and it's super illiquid. The third one I'd touch on is private markets, near and dear to our hearts. We're venture capitalists. We invest. We have 13 portfolio companies. A lot of them are investments into the digital asset ecosystem and fintech ecosystem of building the digital rails. But venture capital, the amount of money that's gone into private markets over public markets is 2x that of public markets. The number of public companies has declined 50 to 70% over the last 20 years. It's really expensive and it's hard to do. Most of the entire capital markets ecosystem has been catered towards these unicorns, these large companies. But in a world of innovation, in a world of entrepreneurship, in a world of where you can actually go online, you can incorporate in your garage a new company and get set up the next day, connect with Shopify, allow money to come in. We're moving to a world of private markets. And so creating an entire ecosystem of private market trading is what digital securities will unlock. All the great stuff we love about public markets, you can transition that over to private markets to allow people to buy, sell, and trade. And as Stephen was mentioning about the bonds, the counterparty risk, it's the same thing if you're buying and selling from two people around the world. Before the trade goes through, it looks at the code and says, are we breaking any laws in your country? Are we breaking any laws in my country? Are you an accredited investor? And if any of those fail, the trade doesn't go through. So significant opportunities. And just to show you how material it is, I mean, you can pick up the newspaper, Fidelity, Goldman Sachs, JP Morgan, NASDAQ, everyone is touching in and around the space. And one actually that came out yesterday that's amazing. And again, inevitability of this, it's happening, okay? It's there's a timing element and there's an education element. But yesterday, or 24 hours, 36 hours ago, the DTCC came out again. So the DTCC is the custody solution that does the settlement trading monopoly in the United States, $2 quadrillion of securities. That includes derivatives, but 2 quadrillion. So that DTCC underlies a lot of the US institutions, came out and said, one, they're announcing a project where they're focused entirely on settlement and trading because they recognize that's their entire business model and blockchain's gonna make that go away. And the second is they are going to put as much attention as they have in the private markets as they have the public markets. So one of the major large infrastructure players of the securities trading asset classes in the world has announcing that they're looking at settlement and trading, which blockchain eradicates, and private markets, which is a significantly large asset class and entirely illiquid. So you can see the major players in the space continuing to move.
That's very interesting. Now, I wanted to highlight something you said about the decline of companies going public, and there's going to be a huge opportunity for companies that don't meet those requirements to start going public and be traded. So specifically for RIAs or financial service professionals, it sounds like they're going to have access to a much greater pool of potential venture capital deals that they could put their clients in or themselves. Like, is that what I'm hearing?
Yeah, and just the opportunities getting bigger as well. There's more venture investing opportunities, and we've structured a fund for folks to get in as well. More venture opportunities. There's a lot of companies innovating and building out these digital rails with us. So there's a huge opportunity for folks to invest there, and lots of access. And I think probably I'm curious actually, the folks on the phone, how they think about when they talk to their clients, venture investing and alternative investments, what that percentage looks like. I think, if you look at Morgan Stanley, may say 25%. I think you could say if it's like Bitcoin or crypto, maybe you start at 1 or 2%, but it's somewhere in there. But the reality of it is, and I think it was you that Stephen said earlier, or even you, Sonny, mentioned that you're still investing in real estate. You can call this an alternative investment, but it's a traditional asset. It's being enhanced by digitizing, so it's not that risky. But on the venture side, there's significant opportunity.
So that's a great question for our audience. So I'd be curious if anybody's willing to share, how is it, like, what are the percentages that you're talking about with your clients about venture and potentially some like an alternative like digital assets. So if you want to put that in the comments, we'd love to hear from you guys and know where guys and girls in here, where we're all at with that. And I want to address a bit of an elephant in the room in that, and we've already talked about it just a little bit, but volatility and compliance. So there are people, Stephen was mentioning earlier, there's so many headlines. Actually, it was Kyle mentioning earlier, there's so many headlines about in the past, crypto being a dangerous space to be in, and ICOs was a thing, and Bitcoin, and there's volatility, and people aren't exactly, there could be some unrest around that. So I wanted to address to Stephen, what about, talk to me a little bit about the volatility and compliance of this. What about those who have concerns with that volatility and compliance as it relates to digital assets and specifically digital securities?
Yeah, that's a really good question. So I think the problem is that most people look at Bitcoin and think of Bitcoin as this digital asset, and it represents all other digital assets. We're really, Bitcoin is it's in the US anyway, and in many other countries, it's categorized as a commodity. So that's really the asset class that it sits in. By the way, Goldman Sachs came out with a report just in the last 24 hours about, and saying that cryptocurrencies are not its own asset class. And I actually agree with that report in many ways. I see Bitcoin as a separate classification, and digital assets is something that you can apply to all asset classes. Bitcoin is just one thing that's digital. But so even though Bitcoin is volatile, digital assets themselves actually won't be that volatile. And as I said earlier, when there are problems in the market, whether it's, and right now is actually a really good example where there's a lot of volatility in the markets, credit seizes up, trading seizes up, because you start, you don't know where who to trust. You don't know where to go. So if you can't trust a counterparty or can't trust multiple counterparties, you just might stop trading for a little bit. But if that trust comes back through a distributed ledger, then trading can continue to happen as long as there's a counterparty on the other end, and you don't have to worry about that trust in the market. So I actually think that it will create less volatility in asset classes that historically should have less volatility themselves. So, but pointing to the volatility around, say Bitcoin or even other digital assets, really that's due to speculation. Risk assets typically have more volatility than non-risk assets. And the riskier you are, the greater potential return, also the greater potential loss. So anything that's a riskier asset is going to have greater volatility, whether it's digital or paper. It doesn't really matter. And it just so happens that at the moment, many assets that are digitized are risk assets that have greater volatility. And as this space begins to develop and we start applying it, the technology to bonds, to stocks, to real estate, things actually should stabilize a lot more, in my opinion.
And I know that one of the products that we have, the digital asset fund, actually, you have a deep history of managing many kinds of asset classes. It's, it's diversified such that exposure is relatively limited. So you can gain on the upside, but not be, not be in something where you could be wiped out.
Yeah, I mean, look, there's risk to everything, but yeah, we do manage it to where we do try to manage the volatility and the risk by holding things that are safer at this point in time, as well as things that we believe in, such as venture.
So I'm curious now, I'd like to switch the question over to James Wallace. And you talked about inclusion earlier. You mentioned it kind of at the top of this webcast, and how big of a deal that is, that we're opening these asset classes, these investment opportunities that have not traditionally been available to non-accredited investors, and making some of them available to accredited investors. And that's a huge move forward for inclusion. But I'm curious specifically for the RIAs or financial service professionals that are on the line, something that we've heard mentioned, and those that we've talked to, is, what's the benefit of an RIA when people can go directly and access these investments on their own?
It's a good question. Before I answer that, I just want to back up and comment on something that Kyle said, and actually Stephen expanded on as well. And that is that because of the nature of the things that we talked about, media has misunderstood it, technologists have not explained it properly, current participants are attacking it, et cetera, we still really misunderstand digital, and we've had to position it actually ourselves. Somewhat frustrated, but just accepted the market is where it's at. We've had to position it as an alternative, and we actually describe it as alternative in a traditional vehicle. But the intention is that over a period of time, directly with the investor or through the RIA, we're able to take them to a series of epiphanies, which is just catching up with the technology, what it offers, and how that interfaces with regulatory requirements, and also how to get access to high quality assets. Those are the three things that we know are critical in a good trade or a good acquisition of investments. But the reality is that through these series of epiphanies, people get to the point where they realize, as Kyle said, oh, this is actually traditional. So we say alternative in a traditional vehicle. But the reality is we get to the point where we say it's traditional with an alternative enhancement or a new enhancement. So this is real estate. This is fixed income. This is equities, public equities, some access to private marketplace and venture deals, typical assets that are enhanced with digitization and are able to be fractionalized to 18 decimal points, ported to foreign markets, able to be traded for 1/5 to 1/10 the cost, et cetera, et cetera, et cetera. All the things that become essentially enabled. And there's a thought out there that this is not happening. Security tokens are a ways off. Digital securities are a ways off. Representations of conventional paper assets in digital form are a ways off. And it's actually not true. There are billions of dollars in trades occurring right now in digital securities. Through our regulated exchanges, significant amounts of security tokens and digital securities are being traded cross-jurisdictionally with interoperability across multiple chains. It's happening, and it's happening very quick. And typically, as they say in the venture world, drip, 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 flood. All of the things that needed to happen to verify systems, stress test systems, check them against multiple regulatory bodies, get participants, the early adopters, the ones that are motivated simply because they're worried about competition or they're really excited about the returns. These people have all de-risked this to near zero. And now we're going to have people, even though, as Kyle also said, this is very, very early days. So there's just significant opportunity. This is one of the last chances to get in on the early days, because all of a sudden it's all going to be wrapped in digital form simply because the value and the benefits are so significant. Moving to the question, back to the question, Sonny, that you asked around inclusion. I mean, our intention, our mission, sort of a social mission, is the absolute democratization of two things: early stage investments and early stage fundraising. So we want to, as venture people, help enable value creators to raise some capital to build their thing and bring awesome stuff into the world. We also think that it's not compatible with a free society and a true free market, true open economy to restrict the best investments in the world to accredited investors only. So our intention, and when we launched the digital asset fund in Canada, it was retail public eligible, it was retirement savings eligible. We wanted absolute full access to it. Now, the inclusion part of it, we see the digitization side, and we think that a lot of the fees that go along with the typical selling of assets, and when I think about maybe even just securities trading, the listing fees and the transaction fees. And then on the other side, we have transaction fees. And in the middle, we have the relationships. And I actually think both sides of the setup fees of instruments, financial instruments that can be traded, which is very expensive to create a fund, to create shares, to create listings that trade shares, whether it's a mutual fund, an exchange traded fund, whatever the case may be, all these costs are significant, which decrease the number of potential investments available to investors. And on the other side, as we said, 9/10 of that is participation, custodians, transfer agents, clearing and settlement, et cetera, the vast majority of which is not required with this new technology. So the 1/5 to 1/10 the cost that goes away is removing unnecessary market participants. Now, how that relates to the RIA and people that actually have intelligence around all of these investments, and then have a pool of investors or a set of clients, is that they are positioned perfectly. They actually add value when these people that are creating transactions that are not, providing services in capital markets that are no longer necessary, they will go away. But the people that are representing investors will, need to be there to continue to guide people through the various new digital asset, digital security investments as they emerge. So I truly believe that the investment advisors and the people that represent investors and pools of investors and clients are going to be critical in this stage, and actually ongoing for quite some time. That the relationships, in other words, and especially when there is a deeper intelligence and understanding where guidance and advice can be very useful, is going to be more and more important. So we do know robo advisors and apps, Robinhood, Wealthsimple, et cetera. There's probably a space for that, but I think that people are too busy, not well informed enough, and are going to continue to need investment advisors for the foreseeable future. So there is a potential, actually, in this environment that's being highly disrupted right now. The investment advisors are probably safe for quite some time. We have made a commitment, actually, to support allowing, investment dealers in Canada and exempt market dealers, and there's broker dealers in the US and investment banks in the UK. And we're having conversations with everyone all at the same time, wanting to support them in supporting their investor pools and their clients. So our commitment is to ensure that people get into our investments. But again, because we can't expect everyone to be a blockchain, Bitcoin, cryptocurrency, digital security, digitized, tokenized real estate expert, I think that's an outrageous expectation. We actually need investment advisors. We want hundreds, thousands of investment advisors that we can continue to teach and share and learn from also as well, so that we can build better systems and better products. And in turn, they can teach and guide and advise the hundreds of thousands and hopefully millions and tens of millions of investors that invest in these products.
Well, let me give actually an example of what James is saying, right? So I think right now everybody knows who Franklin Templeton is, because they've been in the news for the last 2 days. But Franklin Templeton actually filed for the very first blockchain-enabled money market mutual fund. Okay, so we've been talking a lot about stocks and bonds and real estate, but the funds that hold these also have transfer agents and are bought and sold in paper format. So Franklin Templeton filed this almost a year ago to be able to put their entire fund solutions on the blockchain. Franklin Templeton manages $500 billion in assets, mostly in mutual funds, and that's what they're really known for. So if you want to really break it down, in their funds alone, they have the potential of saving $250 million worth of fees by blockchain enabling their funds. And the other thing that they're doing that also will cut down on fees is they plan on not only putting their mutual funds on the blockchain as far as their transfer agent goes and eliminating those fees, but creating their own app so that you don't have to go through a broker dealer and you don't have to go through any intermediaries to get access to their funds. You can just go to the Franklin Templeton app, you click on what you want to buy, and you buy it. And that eliminates brokerage fees as well. So it's already happening, right? This isn't something that's like, a lofty the future, Elon Musk flying a mission to Mars. This is happening now. People are already doing it. They're already getting in front of the SEC. They're already filing funds, and we'll probably see something come out in the next year or two, and then everybody else is going to scramble to do it.
So it sounds to me like there's a big opportunity, jumping on both what Stephen and James said, that as more of these, this is inevitable, this is going to happen. And for RIAs and financial service professionals specifically, their value is not going to decrease. In fact, the opposite will happen. Their value will increase as they are providing really great, advice and guidance to their clients, who are going to be, maybe pulling their hair out a little bit trying to navigate this space. Am I hearing that correctly, James?
I 100% agree with that, right? Mm-hmm. I mean, yeah, I 100% agree with that. I mean, all these vehicles are going to be created, and then it's like, okay, how do I navigate it? Okay. And then after Franklin Templeton, then you're going to have PIMCO and BlackRock and Fidelity, and like, okay, well, they all have things that all look alike. Which one do I choose? And then what's really valuable is your investment advisor being able to do due diligence the portfolio management teams and decide, okay, which one is creating the best product that's available for everyone, right? So you've already eliminated a lot of fees, which is fantastic. I mean, and by the way, that's been the move for the last 30 years, right? The invention of the ETF was to eliminate fees from mutual funds. And ETFs, the fees get lower and lower and lower as technological advances have occurred over the last 20 years. This is just simply a new technology that helps to further drive down cost for getting access to markets. That's all it is.
And I hope this doesn't sound as funny coming out as it does in my head, but things going digital doesn't mean people still don't want to manage their own wealth. People still don't want to make allocations in their portfolio. People still want your advice. And in fact, I'd encourage you to, to simplify this. Treat this as a separate asset class for now until you learn more about it. Think about what amount of allocation you'd want to do or suggest to your companies. We're happy to have that conversation. There's a whole spectrum. We'll talk about some of our products, I think, later in terms of how we thought about it, in terms of giving people investment opportunities. But the reality of it is smart people advising will always exist. That's not going away forever. So this is just a more efficient way of doing that. So in fact, I bet your clients are probably knocking on your door saying, what is this digital thing? Explain it to me. So I'm sure you're starting to get pressure there, and hopefully we're giving you more insights, but we're happy to kind of share more and more and more to get you more comfortable to start talking about this with your clients.
Well, that's actually a great lead into where I wanted to go next, which is, Kyle, what is available today? What's actually out there and available for RIAs, financial service professionals, for people to get in, access this, bring, and potentially pass that along to their clients?
Yeah, so we've alluded to it a bit on here. I'd say, Exponential has two funds. We're also invested in a company on the crypto side, but the first fund I'd mention is the digital asset fund. And that's really the way to think about that one actually is, we wanted to go straight to retail. That's the one that has retail access. And so if somebody wants to invest in their pension fund into a diversified product that gives them exposure to digital assets, this is perfect for them because it has real estate, it has venture capital, which, by the way, you're welcome, you didn't have access to before, and we're happy to bring that to you. Precious metals, crypto, it's a diversify. There's 7 or 8 asset classes in there with the anchor in real estate. It can't go to zero, you still own the building. Venture, everybody wants access to venture, particularly in light in today where things are going digital and things are moving here. So high return upside there and a balance of other portfolio asset classes. The other way to look at that is if you want to say, look, I'll get you, we have an opportunity to invest in something that gives you exposure to digital assets. But this is sort of the beginning investment because the reality of it is it's real estate in there and other traditional asset classes. So it's giving people that exposure in there. There's some amount of cryptocurrencies that will be in there, probably like 5%, 10%. So you'll have exposure there as well, but it's the beginning to really understand. But the reality of it is this has been built to be pretty diversified and safe, but digital. The next step down is directly investing in venture. Our venture fund, which today, as I mentioned earlier, has 13 portfolio companies, most of which probably in the fintech domain, front funder, the privatizing access to capital markets in Canada, the global stock exchange, it's a digital security exchange, developing a platform for global trading out in Europe. And you can invest in the venture side. We are also on the board an investor in 3IQ. They were the first North American Bitcoin fund. So if someone says, look, I want to invest in cryptocurrencies, predominantly Bitcoin, I'm probably more Bitcoin maximalist than some of the other folks on the panel if they want to chime in on that one or smile or nod. But Bitcoin being an investment vehicle in one of our portfolio companies has provided the fund listed on an exchange literally a few weeks ago to provide access to that portfolio there. We provide some services as well, investment management, where we can, for this group, I think it'd be more on the segregated managed account, meaning if you guys came to us and said, look, my client we want to allocate some capital to digital, X amount of the portfolio, call it 2%, 5%, et cetera. We'd like to think about you guys managing it. That could be a conversation we have. There's some thresholds there, there's some screening, there's more conversations, but that is a service we provide as well. And I'll let Stephen chime in on that piece. And then the other one, which is coming in the next quarter, we just listed our first portfolio company today on the Gibraltar Stock GSX. And the opportunity of different assets and investing opportunities will be available through us into our exchanges, which are our portfolio. That'll eventually come. That's probably going to lean more towards people that like to invest in direct deals until we create funds or SPVs around that, where you can get a concentrated basket of certain things. But today it's the digital asset fund, the digital venture fund, and then there's a conversation to be had about the investment management side.
Awesome. Thank you for sharing. Guys, this has been awesome. I want to wrap up the kind of formal section of this and move into Q&A so that we can get some of the questions answered from the audience. I see that there's been a fair number of really good ones. Before we jump into that, so if you're listening, you're on this, please feel free. Now's the time to type in those questions. We're going to try to get through those and get you some great answers. And also, if you're curious about this, you've heard what we've talked about, you want to explore digital assets in a greater capacity, feel free to head over to go.exponential.io/RIA info, go.exponential.io/RIA info. You can see it on the screen there, and that'll give you an opportunity to book a call with some of our digital asset experts, and also access this directly through Deal Square, which we have set up there if you're set up with them. So without further ado, let's jump into some of the questions. So I see, Corey, that we had a question from Glenda. Glenda asked, with real estate assets in the private market issuer funds pushing exits out to who knows when, could fractionalization help to restructure these to help the lag time and the success of the project? Who wants to jump in on that? Send it over to JW potentially. And if we're not comfortable with this, totally great. We can email this after the answer.
Well, I think one of the first opportunities people look at from a digitization standpoint, and also one of the first challenges that people make, like why digitize real estate? There's REITs. They're very so real estate investment trusts. Everyone on the webcast probably knows what that is. And the performance is great. Why do we care? And to a large degree, that's true-ish. It doesn't allow the investor to shape the type of investments that are made. Yes, each real estate investment trust said, we invest in downtown Philadelphia, commercial office property. That's what we do. We do it very well. For some of these older REITs, they have past performance. It's good. That's true. And I think it's important to recognize in the market things that are performing well or have performed well in the past. And we obviously know in real estate markets and equity markets and fixed income markets, there's cycles and there's meta cycles. We're just seeing sort of the equities market fall out a little bit, et cetera. So it's really easy to judge when it's performing very well, but real estate post 2007-8 has performed very well. I don't believe that I'm an expert. I think there's more people. That's why I paused. Probably even on this call, I can comment better. But the one thing that really pops out to me is that the performance is one thing. And I think that as we see more and more REIT type digital issuances, we're going to see two things. One is that I believe the performances are actually going to improve even further because people are going to specialize even more than they currently are right now. There's only a handful of REITs in most jurisdictions that are well known, that perform very well. We're going to see people really specialize. And anytime anyone specializes, not anytime, but most of the time people specialize, there's outsized returns. The second is, as you said, fractionalization as well. So the ability to get in at a fraction of the cost of certainly a piece of real estate, but even some of the pricing for REITs themselves. And as Glenda's pointed out, really you've handed over to a small group of very dominant, real estate investment trusts manufacturers to determine things like exits. So what, the contributions that came in up until this point were with the understanding of past performance that there was sort of exits and liquidation every so often. And now the market's changed, and that's changed significantly. So I do think that having specialized real estate investment trusts like digital instruments, allowing people to come in at lower rates, are going to outperform REITs over a period of time. So I think what Glenda's pointed out is a really good point. More competition is going to improve things for us.
All right. And a question from Xavier is now the right time to be digitizing venture cap tables and move forward with blockchain technology? Kyle, I think I'll throw this one at you.
Yes. Is that enough? The reality of it is, the number of cap tables we see, and depending on how much time you spend here, the number of mistakes you can see in a cap table is probably a large part why, honestly, fundraising becomes a challenge later for a lot of companies. Because if you don't know who owns your shares and it's not cleaned up, then the reality of it is it becomes a significant challenge when you go to raise funds. The earlier you digitize, the faster it is to not be an issue, because you've got a recorded record that's, Carta's made a huge name for itself. It has actually created the cap table management for private securities. Automated way. They, however, not using blockchain technology yet. So there's probably a shift there. I'm sure they're looking at it. They're backed by a lot of folks, but digitizing earlier. So there's one of our accelerator strategic partners we're talking to wants to digitize their entire venture portfolio, 40 companies. What do they want to do? They don't need to list, they don't need to trade it, although we're excited about that, allowing liquidity into private companies. They want to be able to give out fractional pieces to consultants, to advisors, to own and to come in and help those companies. And they'll be able to manage that at a much easier level with 40 companies. And so if it's digital form, it's easier to manage. There won't be a mistake. And it's better to do earlier in your journey rather than after a fundraise, particularly if you're bringing in multiple fundraisers. We have a company now who has 300 investors. It was friends, it was families. Then it went beyond that, but there were small chunks here and there, and it was in Excel. And there's a lot of mistakes. It took a lot of time to fix it, and that's a problem. And I think the earlier you digitize, and by the way, this is something we're super focused on to help people, because it doesn't really cost anything to digitize your cap table. A lot of our portfolio companies, we're going to be going through this exercise. Most of them are digital at this point, or we're moving very near soon, but we're pushing it. It doesn't cost a lot to do it, but it can save you a ton of headaches in the future and make it a lot easier to fundraise in the future as well, especially when we're advising folks when they should list or trade later. So it doesn't cost a lot of money, and it's going to save a lot of headaches. So I would say absolutely, most ventures, it would make sense.
Sonny, if you don't mind, I'd just like to comment on what Kyle said there, just to expand it just a bit. He's absolutely right what he said. But before I do that, Glenda inspired this thought. And again, it really comes down to realizing that what we're doing with blockchain, sort of issuing these securities in a totally regulated manner, enabling these private marketplaces and also global trading venues to interoperate, is that we could take 1,000, 10,000, 100,000 of these shares inside that REIT into a fund, and we can digitize that and fractionalize that and sell it essentially as we want, or provide access to people. So let's say the cost of the REIT's $1,000. They've sort of gone back on their word, or contrary to their past performance, people need liquidity. We can actually create that. And the thing that the people, and I would highly recommend RIAs that don't know what a GDR or an ADR is, look into it. Global Depositary Receipt or an American Depositary Receipt. And this idea essentially is, so an Apple, how do people in Britain buy Apple shares? An investment bank or bank buys Apple shares and holds them, custodies them essentially, wraps that in a GDR and ensures there's usually compliance requirements such as language and so on. So the harder example would be, say, some Asian tech startup that's exploding and Americans want access to that. An American bank takes it and wraps it with an ADR. The requirement is that bank translate the documents to the investors, et cetera, to be compliant. So there's already a framework that's available that we use, we rely on heavily to help regulators and banks and anyone understand what we're doing in these other markets. But I just wanted to say that the framework that we have actually potentially solves existing problems, not just provides competition, but we can introduce and create liquidity for something that's struggling right now. But to Kyle's point, I just wanted to say really quickly to Javier, because I think the question is very, very good. And if we look back on the somewhat unfortunate ICO era, but it did create a lot of awareness. And I think that now we've become thankful for that sort of madness and explosion, and sat back and said that showed an insatiable appetite for people to invest. It also showed that, again, the promise of early stage raisers and getting access. Cool. How do we do that in a compliant way? And I think that that's what we set out to do, and others have as well. But the really important thing to consider there is, as Kyle said, the digitization of the cap table. Why not do that? There's really no downside to that. I think what a lot of people then jump to is, oh, so then I go raise a bunch of money and then I list and I exchange and secondary trading and so on. I don't think that's the idea. Kyle actually comes from an investment banking background, and he understands the value and the need to really mature companies through that capital markets life cycle as they prove out idea market fit, product market fit, become fundable on actual sound principles, and then continue to gain more and more funding as they go to market. So we believe the digitization of any shares, really, there's no downside to it. Better than managing in an insecure spreadsheet that is prone to human error and maybe even theft. But having experts like us, we have venture capital experts, we have investment banking, growth stage fundraising experts, we actually have digital securities listings and exchanging, primary issuance on the securities exchange, secondary trading, market making, liquidity. All of that needs to be considered. Whereas in 2017, the explosion of an ICO, it was a bunch of tech people that issued an offering on a white paper and raised tons of money and then totally mismanaged it. We're saying issue the digital share and then have a competent internal management team with high financial intelligence, and wrapped hopefully with an organization like Exponential to make sure that all the right things are done at the right times.
Can I just add something, JW, on the real estate point you brought up? I'm definitely not a real estate expert by any means, but my understanding is the land and then development, and then you start building the building, there are stages. I think even corporations, and we didn't want to get this complex on this webcast, we were trying to keep it simple, but the reality of it is corporations and people in the real estate ecosystem, each phase, and I'll use real estate as the example because that's been the topic, can, once this technology, people understand it's cheap to do, it's effective, people trust it, it's going to be used more often. So you can actually fractionalize the different stages, allowing investment into these different stages as you're building these developments, from land all the way to the building and tenancy taking place. The reality is you can de-risk every step of the process, and you can actually allow people that want access to that. Whereas before, it was just huge, large institutions. And I think the reality of it is corporations, once they also get a hold of this as well, they may see a certain opportunity or a project they want to get into and open up access to something separately outside of their public company stock. And actually, the sky gets to be the limit. And the reality of this technology is enabling this to be much easier for different investors to come in, but also companies and everyone to de-risk things by spreading out investment probabilities at different stages of project life cycles or real estate, et cetera.
It sounds like we're really just beginning to scratch the surface of all the problems and inefficiencies and, challenges within the current system that will be solved as we move into this digital space. What an exciting time. And cool. So I want to say the last question that we have coming in. So JW you had answered this, James, already in the comments, but I think it's worth bringing up here just so everybody else can benefit from that. Can an investment advisor legally recommend Bitcoin or crypto as a part of a portfolio?
My response was, I'm not entirely sure. I understand how critical it is to ensure compliance and make sure that you're operating within regulation. But fortunately, and I forget who, I think Kyle mentioned 3iQ, our investment in 3iQ, and that was certainly not a plug. It's just simply the only way in Canada and in other places as well to get access to something that is regulated, which they have a Bitcoin fund. It's called QBTC, and essentially what you'd be doing is recommending that your investor buy shares in the fund, and so the underlying is cryptocurrency, specifically Bitcoin at this point. It's been called actually the Bitcoin Fund, and they spent 3 years with the OSC back and forth trying to prove to them that they could safely custody, ensure KYC, AML, et cetera, and eventually triumphed after many millions of dollars in many years. And I think lots of innovation. So lots of internal mechanisms and systems that ensure, compliance for the fund, obviously, and then by way of that to the investor. So my recommendation would be, if there is any concern about recommending anyone holding directly any form of cryptocurrency, and there's certainly risks involved. So putting aside AML risks, like the source of it, where did the Bitcoin come from? Although we don't apply that same requirement to cash. When I get a $10 bill back from the cashier, I'm not wondering if it came from a criminal. So I don't know that AML is really fair in the currency world. But putting aside that, setting up a wallet and the difference between a mobile wallet, a desktop wallet, a hardware wallet, and then obviously custodians, that alone could be problematic for the investors. So unless and until, even if it's compliant, unless and until you know that they're sophisticated enough to manage their own digital assets, I would highly recommend just buying through a fund. So I think 3iQ's QBTC is a great option.
Yeah, I agree with James. It's a great option, but I'm also going to say that there's many advisor platforms that won't allow you to buy it even through a fund, such as QBTC. In those cases, the way that I like to own Bitcoin is through actually owning 3iQ itself. So as the price of Bitcoin goes up, or as they grow, that company becomes more valuable, which is another great way to play it if you're not allowed to buy it. Own it through venture.
And definitely not legal advice by any means, but I do think in the US, the CFTC came out and said Bitcoin is considered a commodity. So from a legal perspective, I think you could look into that. I'd also encourage all the RIAs to look at their firms, look at your companies and see what your policies are and how you guys think about it, how you guys talk about it. Like, what is your firm approach? And really look inside and have a conversation about how you guys holistically engage and talk about digital assets with your clients. And again, we're happy to be a part of that conversation. That's the whole point of this thing. As mentioned earlier, we're here to help educate you. I think we're gonna have to work together on this and educating the world and providing access to a lot of these investment opportunities, but I'd encourage you to have those internal conversations with your firms to talk about where you guys stand. And if there's an impediment in your way, we're happy to have a conversation on that as well, in terms of how you guys are thinking about it.
I'd actually just want to add too on what Kyle said. My strong advice, and I don't typically like to give advice because I think everyone's hopefully smart enough to figure out their own reality and make their own decisions. But the advice is go out and buy some Bitcoin. So as an investment advisor, first it'll do a few things. One is, if you want to sort of put your flag in and know that you're going to follow up and learn and integrate and figure out who are trustworthy market participants, et cetera, we all know you buy something and you start paying attention, your interest level is going to go up immediately. So even if you're just saying, well, yeah, I read CoinDesk and I follow some stuff, not the same. You buy it, you're invested, literally invested, and you're invested in learning. And I do think, as so many people have said, this is definitively, there's no question this is happening. The only question is how quickly. And as an investment advisor, I think it would almost be probably some sort of regulatory or fiduciary responsibility to investigate this. So if that's the leverage you need to really dig in, and it could be just $100 worth of something, could be Bitcoin, could be something else, buy it, store it, figure out exchange wallets, desktop wallets, mobile wallets, hardware wallets, learn about custodians, learn about the insurance. Like BitGo offers $100 million worth of insurance. People find that shocking. They didn't know that there's actual custodians that are holding paper assets and digital, and they're fully insured. I think even if you can't bring that immediately to your investor, the amount of learning, first of all, is exciting. It's really interesting stuff. Secondly, it's going to remove a lot of the mystery. It's going to remove a lot of the fear. Third, you might just become a much better investor yourself. And fourth, you may actually be able to communicate to the dealer that you're working with that they should look at this from a top-down perspective. And fifth, eventually give your investors great investment advice.
Great advice, guys. Thank you so much all for being here. Everybody on the call, if you are interested in finding out more about digital assets, you want to speak with a member of our team, get some specific questions answered, please head over to go.exponential.io go.exponential.io/RIA info, right on the bottom. Go.exponential.io/RIA info. That'll give you the opportunity to book a call with one of our team members, or also if you're integrated through DealSquare, access the digital asset fund directly as an RIA in Canada. So I want to take, you can, by the way, you can also, if you're curious or you're not wanting to book a call, you can also email me and I'll make sure it gets to the right person. Sunny@exponential.io, SUNNY@exponential.io. James, Stephen, Kyle, and Corey moderating for us. I want to just take a moment to say thank you for being here and sharing that wisdom and helping us wrap our heads around this digital asset paradigm.
Thank you, Sunny.
It was a lovely
Thanks, Sunny.
affair. Yeah,
Cheers, everyone.
Awesome,
Thanks
guys.
a lot.
Thank you so much.
thanks to everybody who attended. That was wonderful.
Yes.